Hi guys, it's Dr. Robinson. It's December 15th. It's about 3:30 in the afternoon. This is not our normal meeting call or anything. This is just a recording I'm doing. It's going to be a short one based on what's going on in the market right now. If you're watching the market, we're having a sell-off in the equity market. The bond market is rallying, and it's rallying quite hard. And the dollar is also rising. So Forex markets are on the move as well. When those three things start moving, we have to start paying attention to what's going on. So let me explain to you what's going on so you can kind of take advantage of it in your own personal stuff if I'm not managing your money. If I'm managing your money, if you're one of my full-time clients, I'm already on top of this and we're dealing with it as we speak. So what I wanted to show you is what's going on in the bond market. Just real quickly, by the way, you'll notice that the short bonds, say the T-bills, the four-week T-bill, 13-week, 26, and the 52-week T-bill, aren't moving a whole lot. You've seen a little bit on the one-year bond. It's down 5.1 basis points. Remember, prices work or move inversely to yield. So as yields go down, prices go up. So there's not a lot of change in the short bonds. So think of them as the T-bill market. Not a lot of movement, a little bit of movement on that 1 year, but that's about the only one. Where there's bigger movement is in the treasuries, the what we call T notes, the 2, the 3, the 5, the 7, and the 10. Those are all moving sharply. Now remember, it's only been 5 days since we last looked at bond prices and bond yields. And the bond yields, you can see, have moved down quite a bit just in the last few days. Now, historically, when we know that the bond market is worried about what the Fed is doing with interest rates, we expect that the longer or the T notes, these are, and bond, remember, by the way, T notes, in case I haven't explained to you, T notes are bonds with 2 to 10-year maturities. So when the T notes are moving in any way, in general, when they're worried about what the Fed is doing, T notes, the yields will go up. And we've seen that for the last year. So T notes are consistently going up. But it's strange right now that the T notes are going, the yields are going down, which means prices are going higher. So bond market is moving higher on the price side. And I'm not talking a little bit, by the way, we're talking significant movements in the bond market. The question becomes what's causing that? If you look at another slide here, if you look at what's going on, and they get these numbers as of 3 o'clock this afternoon. So it's 3:30. So that if you look at the market, it's probably a little different than what I'm looking at right now, or what we're looking at right now. But as of 3 o'clock, the Dow was down 735 points. That's 2.11%. The S&P was down 91 points. That's 2.25, almost 2.33%. The Nasdaq's down 321 points. That's almost 3%. The equity markets are taking it on the chin today. And then the Russell 2000 is also, and that one doesn't move that much. 40 points is a lot. It's 2.22% on the Russell. So a lot of big movements. But notice that one in the bottom. That's the one that's telling. The dollar's actually going up. The dollar should be going down right now, by the way, when interest rates are doing what they're doing. So we should see a weaker dollar, not a stronger dollar. And yet the dollar is getting stronger. So the question becomes, why is the dollar getting stronger and yet the bond market in terms of yields are getting weaker? The yields are coming down. Normally when the bond market is or the dollar is rising, that brings investors into the marketplace, and you would expect the markets to kind of respond accordingly to that. So we're kind of getting an anomaly here. But what that is that's the bond market telling us that we're no longer worried about what the Fed is doing, or I should say we, but the bond market itself is no longer really worried about what the Fed is doing on interest rates. They believe they've basically kind of capitulated right now and said, no matter what the Fed does right now, there's no way to avoid a recession. So in a recession, bond investors always flock to longer term bonds. The reason they do that is because they have a lot further to fall than the short bonds, and they'll do it over a longer period of time. Now remember, one of the advantages of bond investors over equity investors is they have a long-term outlook for things. They're not looking for where the stock market's going to be 3 months from now, 4 months from now, or anything like that. They're saying, where are interest rates going to be a year from now, 2 years from now, even 5 years from now? And what they're telling us right now is that interest rates a year from now or 2 years from now are going to have to be lower. What that means is the Fed at some point is going to have to stop raising interest rates. Now we know they're going to, They kind of told us in their meeting yesterday that the terminal rate would be about 5.1%. Now remember, right now we're at 4.33. So there's a possibility that we're very close to where they terminate. But that does mean that there's still 60 or 70 basis points that the Fed can still raise rates, still be within their 5.1 terminal rate area. The bond market's not believing it. The bond market believes that we're going to start heading into recession, and as things pick up, the Fed is going to have to reverse course and start lowering interest rates. And that's why bond investors go into these long bonds. It takes a while, so we're not looking for overnight gains. Now, we've got some pretty good gains for the day. Even as late as I got into the bonds for some of my clients, we've got some pretty good gains for the day and for the week. But having said that, this is a long-term thing. So we expect bond rates to continue, the yields, I should say, the bond yields to continue going down. If that's true, if this continues to happen for the next couple of weeks, we'll know for sure that the bond market is truly pricing in a recession, and it might be a little bit deeper recession than what I've been alluding to in the last few months, simply because the bond market it feels like it's capitulated today. Now, tomorrow it could reverse, who knows? But at the end of the day, right now, it looks like the bond market has capitulated, and it's no longer interested in what the Fed's doing. They're more interested in capitalizing on lower interest rates a year from now, maybe 18 months from now, that sort of thing. So they're looking to buy those bonds at today's prices. So I just wanted to bring you up to speed on that for what you need to do or what you're thinking. And I have one more screen. I actually have two screens, I think. So the bond market is screaming. The short bond yields are slightly biased to the upside, so prices are going to head lower. So we don't want to be buying any low short bonds. Long bond yields are falling, which means the prices are heading higher. That's where you want to concentrate if you're a bond buyer. Now, by the way, most of you, or a good portion of you, probably aren't bond buyers. Bonds are primarily for conservative investors who are not very far away from retirement. And by not very far, I'm talking maybe less than 5 years or so. If you're less than 5 years away, 3, 5, and 7-year bonds are probably a good deal. The equity markets are moving against the bonds right now, and the dollar is rising. So what does it mean? The bond market is telling investors that we're moving from concerns about Fed actions to recession fears. Long bonds are likely to rise significantly higher as yields continue to fall. So bonds are no longer off the table. So if you are a bond investor, if you've got a portion of your portfolio in bonds, you should be concentrating on bonds in the 3, 5, and 7-year period. I wouldn't go out to 10. 10 would get you more money if the bond market is right, but there's always that possibility the bond market is wrong. So we've got to be careful there. So if you are thinking about bonds, 3, 5, and 7-year bonds would be suitable. You want to stay away from the shorter bonds, and you probably want to stay away from the longer bonds, the T bonds themselves, anything over 10. And I would include the 10 with that, by the way. So I'm not willing to do anything on the 10 yet, but we'll see in the future if we want to add the 10 to the list here. But 3, 5, and 7-year bonds would be the best if you're going to go that route. So that's all I've got for the moment. We'll do our normal meeting on. I'll do it on Saturday, and we'll get that posted to you on Saturday so you can listen to it for all our financials and stuff. Just wanted to bring you up to speed on what's going on in the market today and how the market's reacting and what the market, I think, is telling us. So other than that, guys, it's 3:37. I'm going to go close out my brokerage accounts. I think I've done all the trading I'm going to do for the day in terms of getting bonds for some of my clients, and we're staying out of the equity market for the moment. And we'll see you tomorrow for those of you on the call, and then I'll get that meeting out on Saturday for the others. So having said that, have a good night, guys.